Time now for Wall Street Beat. We take a look at what's buzzing on Wall Street and the world of banking and finance. And today we're taking a look at Rhythm closing the deal, maybe, on Sculptor Capital. Joining us now, Bloomberg's Sally Bakewell. This has been an unbelievable drama. The bid is up from $11.15 a share to $12. Boaz Weinstein had his own grouping to sort of try and take Sculptor instead. Is this a done deal for Rhythm now?
Right, so in this latest marker over the future for Sculptor, Rhythm has upped its bid by about 8% and Sculptor has accepted it. But the question is this a done deal? And I think the answer is very much no. We could well see the saga continue. The big hurdles, well, Dan Ock, who is the founder of Sculptor and who, along with former executives at the company, owns about 30% of the shares, they still need to approve this bid at a meeting that takes place on November the 16th. Now, in order for Rhythm to push this through. Now, he has shot it down before. When Rhythm made its initial bid, he said it wasn't in the best interests of shareholders. And he also has publicly said he prefers a competing bid, the one from the Boaz Weinstein camp, which is higher. So hurdles remain.
Is the market moving for or against a higher price at the moment, Sally?
I think it's very difficult to say, and that there are arguments in favor of both sides. So with the Boaz Weinstein bid, it's $13 compared to Rhythm's 12. There were also concerns about that bid that it didn't offer so much certainty of completion and of execution. And Boaz Weinstein, he has loosened certain terms and effectively agreed to execute the deal, even if they don't have all the agreement of all the investors in some of the hedge funds. And so it really there is still a lot that remains to be seen about these two bids, but what we do know is that Weinstein, he's still keen. Dan Ock is the key player here, and his support is crucial.
Right. I guess what I'm really asking is, as the world becomes more uncertain and more difficult, is this business inherently worth more or less?
So Sculptor has been sort of decaying over the last decade. It saw about 30 billion of outflows from its funds in 2014 following a bribery scandal in Africa. Now, Weinstein, he's made his name investing in very esoteric corners of the credit markets. He has about 4 billion in assets, and he would try to subsume this company. But there are challenges for him if he were successful. He would have to hold on to, hedge fund clients. He would have to convince his Saba Capital Management that he is, prepared to do the work for those investors while taking on this company.
Sally, that's what's perplexing, because Weinstein can't take it to shareholders to just ask them. Like, the obvious thing is take it to clients and be like, hey guys, if I took it over, would you stay? And he can't do that, right? Why?
So yeah, he has to, effectively this has to get approval from, Rhythm has to approve it on November the 16th. Shareholders have to approve it on November the 16th. I think Weinstein, there are lots of issues surrounding things like NDAs, what information shareholders have and what information they, the two bidders have access to in order to sort of make their cases known.
It's going to keep going for a while, isn't it? I feel we're going to be talking about this for a bit longer. Sally, great stuff. Thank you very much indeed for updating us. The latest chapter, maybe not the final chapter in that saga. Let's talk about where markets are today. Here in Europe, obviously we've been paying a great deal of attention to that CPI print out of the United States. That certainly has set the tone this afternoon. Stock 600 going nowhere. We're right in the middle. I think since the beginning of the year, I can't remember, I think the average is 456 or something like that, but we're there or thereabouts in terms of the average price. We're right in the middle of the range for the year. So that's where the Stock 600 is right now, going nowhere in a hurry. Euro dollar getting knocked down on the back of the CPI print, a little bit of a stronger dollar. Front-end yields come up stateside. That's an obvious reaction to what we're seeing. The other thing I just want to draw everybody's attention to is, again, we've seen a tick higher in European gas futures. There's a number of different factors coming together here. We are miles away from the peak we hit during the middle of the crisis. But nevertheless, just incrementally, we are moving higher and higher again. The prediction is for a warm winter, but a few people are certainly starting to place a few bets that maybe this market's going to be a little choppier. Anyway, we're up by around 13%. Coming up in the European close, Charlotte Ryland's going to join us from CCLA to give us her take on what is happening in these markets right now. What is the next catalyst? Are equities going to be able to deliver a decent earnings season? Plenty of questions remain. This is Bloomberg. Thursday, the 12th of October. Equity markets once again are telling us very little at an index level. We are seeing a very calm market right now, just trying to drifting sideways. As I say, we're kind of on a stock 600 level, right in the middle of the range. Nothing to see here. Anyway, DAX is up and down a bit, CAC's down a little bit, FTSE's up a little bit. Countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So we're going to ignore the index and we're going to focus on the single stocks. BP's up. In fact, the oil complex is doing quite well today. We're seeing oil prices coming back round again, ticking a little bit higher. Is that a geopolitical story? Hard to tell at this stage, but it's certainly having a single stock reaction. So most of the European oil majors are higher. The other sector that's doing quite well at the moment is European defence. Rheinmetall, you could pick Thales. There's a whole range of stocks you could pick here. They're all having fairly good days. Rheinmetall up by 2.26%, Alex.
All right, here, I agree with you, headline level, not that much happening, and the S&P is just off by about 0.1%. I did want to highlight Ford, though, because it had a surprise strike. 8,700 workers walked out of its Kentucky truck plant on Wednesday, and this is a very profitable plant. You wonder if you're going to hear from Sean Fain tomorrow, as we tend to do now on Fridays, about the auto worker strike. Two-year yield, no surprise, up a chunky 9 basis points, which is also surprising that the NASDAQ 100 is still outperforming. And the dollar, no surprise there, also up 0.5%. So this makes sense in terms of CPI, right? The overall index level doesn't tend to make sense in terms of a hotter CPI, higher yields, and a higher dollar, Guy.
Let's talk about that inflation story. So here's Eurozone inflation in white. I've got CPI, US in blue, UK's in yellow. We all go up and then we start to come down. Now, the journey back down is going to be the interesting bit. The journey up obviously caught us all by surprise, or certainly central banks by surprise. The journey down looks a little bit kind of longer lasting. And now we have some little ticks in these curves. So while the Eurozone and the UK kind of moving generally lower, you are now seeing, for the second month in a row, a little bit tick higher in that US data. Are we going to see similar numbers being represented here in Europe as well? This is a disinflationary trend, but it looks like, as we were hearing earlier on and have been hearing throughout the show, that the journey, the easy bit, Alex, has been done. Mm-hmm. Does the harder bit now come? 4 to 2%. Are we ever going to get to 2%? We'll debate that in just a moment.
I mean, and here in the U.S., break-evens are now inching their way higher, particularly on the 2-year. That was something that hadn't happened, even though you've seen the rise in yield. So that's not necessarily a great sign. So let's get a take on Bloomberg TV. Have been talking to a lot of people. Here's what they've been saying on inflation.
A lot depends on the data.
The inflation data,
U.S. CPI data.
We've obviously had actually 3 months of pretty good news on inflation.
We have seen some pretty marked progress on the inflation front.
Inflationary pressures are abating.
Going in the right direction.
2% inflation is a little bit closer than I might have imagined, 6 months or so ago.
Inflation's not anywhere close to 2%.
We're not going back to what we used to call the new normal.
The risk to our view is that inflationary pressures return, and that can be a function of geopolitics.
If we don't get inflation showing signs of moving down below 3% and the economy standing, the Fed could be back in the picture in 2024.
They're fighting inflation that I think is already clearly coming down.
You'll see measured disinflation in the CPI in the coming year.
The last mile on inflation is going to be the hardest.
Well, that brings us to the question of the day. How long is it going to take to get to 2%? Joining Guy in London is Simon White from our MLive team and Sofia Orta y Costa from our Markets Today team. All right, guys, 2% inflation. Simon, how long does it take?
I don't know, but maybe we'll get to net zero before we get to 2% inflation.
Oh, okay, 2050.
That's the
so
clip
long
answer.
time. So your point is a long time.
Yeah, I mean, that's a glib answer, but even if, like CPI fixing swaps, which I think are the best prediction of inflation, because it's inflation traders with skin in the game, even within a year's time, they're back down to maybe 2.25. So even within a year's time, they're not projecting us getting back to 2%. So it's certainly at least a year, but I think potentially quite a lot longer.
Sophia, let's try and wind Sophia up a little. Do we ever get, you think we don't ever get there? Maybe we don't need to get there. Does it really matter if we get there? central banks think it matters. The ECB has got, as Jean-Claude Trichet used to say, a single needle in its compass, and that is inflation. It has a target that is 2% effectively. Don't we need to get there?
We need to get to price stability.
Okay.
And the 2% number is a number that someone puts on price stability because it needs to be something tangible that the markets and people in the economy can understand. But actually price stability is just a level of inflation that makes households and businesses comfortable and doesn't change their decisions. And maybe that's...
So it could be 3%?
It could be higher. I mean, Guy, 2% was slightly random. I was reading actually up on the history of this. It started in New Zealand and then was adopted more broadly, only adopted officially by the Fed in 2012. So even if the Fed is a little bit more flexible with this target, it doesn't necessarily need to communicate it, because, I mean, the problem with having a target is that everyone's expecting you to get there. But what if households and businesses are actually comfortable or become more comfortable with a higher level of inflation? I think perhaps we could be getting there. Maybe not quite yet in the markets, but I think that's what we're looking at, Guy.
Hey, Simon.
The Kiwis.
Wait, I was just going to say that. That is truly frightening. Simon, what do you think? Like, if we just live with 3%, right, it's not like signaled or anything, does that throw off financial stability or what?
I mean, it's kind of interesting. I think the debate is going to get more discussed about whether the Fed whether it's already implicitly raised its inflation target from 2 to, say, 3, or whether it explicitly does. I think if they explicitly did it, that's quite a dangerous game, because then once you've raised your target once, well, what's to stop you raising it again? So the market would keep gaming the Fed. So I'd be very surprised if they ever explicitly do it. But implicitly, I mean, look, it makes a huge amount of sense. Why, you know, they've not even been tested yet, right? We've had, inflation's gone up. Growth has slowed a little bit, but not really anything terrible's happened. You know, Powell's not had his Volcker moment yet, where he's having to tighten rates in an extremely slowing economy. And I just don't think they've got the heart to do it, really. And one way around it will be having a slightly higher implicit inflation target.
Okay, so if we've got an higher implicit inflation target, what does that mean for the bond market? I presume theoretically the bond market should be pricing off 2%. Now, I don't think we're pricing off 2% right now, but if we get into a world where implicitly we're comfortable with a higher target, where does that leave yields?
I mean, people will have to demand more compensation if it's a structural higher inflation environment. If businesses, if central banks, if households are more comfortable with it, then the market has to price that in. I would say, though, the 2%...
Is that what's happening now?
I mean, I think...
Is that the term premium move that we're talking about?
The move this week was very bizarre. The Treasury market being closed on Monday, I think, confused things a little bit. But the fact that we had last week's moves up very, very dramatically in Treasury yields, and then a move lower down because essentially central bank officials were saying that the Treasury market was doing its work for them. Yeah. I mean, where does that stop, right? I think the market needs to understand whether they're pricing inflation or whether they're pricing in the future of Fed interest rates, because at the moment I think it's a bit confused between the two. I think that's starting to happen. But Guy, I mean, 2% inflation target, that's not just in the US, it's also in the UK, and we get the CPI print in the UK next Wednesday. Yep. So, I mean, you're seeing that really ripple through the bond market, but in the gilt market, yields are still lower than in the US, which I think for me is quite surprising.
But that just leads me to sort of the fiscal long-term deficit story, Simon, that when we talk about term premium, we're just baking in something different because of all the fiscal spend that you guys haven't had over there in the same way.
Yeah, I mean, I think, look, I mean, they're all sides of the same coin. I mean, whether it's supply, whether it's inflation, whether it's fiscal deficits, they're all kind of sides of the same coin. And everything always comes back to inflation. I mean, that's what we've had an absence of for most of the past, 20 years, really, if not longer. And now that's what's come back with a vengeance, and that's what's really upending and uprooting all these expectations and relationships that people have got used to. So, things like market will sniff out when changes happen, and even if the Fed doesn't explicitly change its target, it will start to demand, higher compensation, as Sophia said, and that's reflected in term premium.
If you look at three central banks, Fed, Bank of England, ECB, what do you think? Which of those central banks over the next 18 months has the greatest chance of getting inflation back down to 2%?
I'd probably just pick it, Probably the US in some sense. I think, if you look historically, the UK has had very bad inflation problems. In the 70s, it had the worst inflation of all the G10 countries, and not far behind it was Germany and Italy. So I think structurally there's something behind these countries that you end up with much more persistent inflation, whereas the US less so. But that 2% thing, I think, is probably out of reach. And even if it does happen, it's like an instantaneous, touch 2 as a rogue print, and then we come back.
Yeah.
So in terms of long-term average of 2%, I think that's off the cards for a while.
Yeah, exactly. So then we touch 2, and then we burst the balloons and everything's happy and the confetti rains down. Like, that just feels very odd. So Sophia, I guess I wonder, when we have volatility and inflation, what does that mean in terms of volatility for the markets then?
It means a lot of volatility. We're seeing that now. I mean, what's happened this week and last week really kind of reminds you of just how nervous people are and really, really obsessed with this 2% inflation target. I don't think that's going away anytime soon. People are still trying to get used to the new environment that Simon was talking about. The kind of, things are breaking down. Relationships that people had gotten used to in markets don't really make sense anymore because the macroeconomic background is so different. So until we get kind of used to that environment, volatility is likely to stay. And also, we don't have a really clear picture on inflation. 2 months ago, people were saying that actually we're in a soft patch of inflation, and this could mean that the Fed could pause. And now, actually, we're getting a little bit of a reminder that we're not quite done on price pressures yet. So, I think this kind of flip-flopping between higher for longer or pause or whichever it is, or recession here in the UK means more volatility.
All right, guys, thanks a lot. Good convo. Simon White from our MLive team and Sofia Orta-Acosta from Markets Today team. Thank you both very much. Coming up, more on the question of the day. How long does it take to 2%? I mean, Simon said 2050. He was kidding, but still. Net zero first. Charlotte Ryland, the head of investments at CCLA, comes up next. This is Bloomberg.
I think we underestimate how hard it's going to be to go from 4 to 2. Relatively easy to go from 8 or 9 to 4.
Yep.
The last 1.5 to 2%, I think, is going to be more difficult than we estimate, partly because of the disruption globally that we see, which will inevitably affect supply chains somewhat, and partly because it's just really hard to wring out the last part of it.
Always great to get Ralph's take. Ralph Schorstein, Evercore Chairman Emeritus, speaking to Alex and me within the last hour, answering our question of the day, how long is it going to take to get to 2% inflation? Judging by our last conversation, quite some time if we ever get there at all. So what does this mean for investors? If we're rebasing our expectations on inflation, presumably we're rebasing our expectation on yields, and therefore we're rebasing our expectations on pretty much everything. Charlotte Ryland, CCLA, Head of Investments, joins us now. How are you thinking about this inflation story? If it is a long journey to get us back down to 2% inflation, if we are going to have higher yields for longer, that affects everything. How are you thinking about the more medium term if we are going to see 10-year yields in the States, let's call it circa 4.5%, 5%?
Yeah. I mean, I suppose if you sort of take it back to first principles and you think about, what should be a sensible real return, it's probably between 1% and 2%. Add on an inflation figure, let's say 2.5% to 3%. That's probably a sensible place for bond yields to be. And we've begun to see equity markets and alternative markets and property markets adjust to that already. Quite a lot of them moved already.
Well, how far have they moved?
Well, I mean, if you say, look at, say, the US market, is now below its sort of long-term 10-year trend in terms of PE multiples, particularly if you strip out the so-called Magnificent Seven.
Yep.
So I think a degree of that's priced in. If you look at things like some of the REITs, big discounts to NAV. So quite a lot of it is in there, but clearly, that's what the market has been adjusting to over the last few weeks, is this idea of, okay, you might peak into a base rate, but potentially, those is not going to get those cuts that are still priced in for next year.
Charlotte, Ralph was also talking about how the last 4 decades of buying bonds is over. Like, we're in a whole new paradigm now, which has not been really registered within the market. So you say sort of the long-term PE, but the long-term PE multiple is looked at over the last 40 years, and that 40-year paradigm for bonds is changing. Don't you have to change the paradigm then for equities?
Yeah, I mean, clearly a higher discount rate is not terribly helpful for any risk asset. But I mean, I suppose the flip side to that is if you look at some kind of returns that we're getting, particularly in the US market, in terms of the cash flow returns, etc., those are still pretty attractive, and you have to offset that against, what you might be expecting in terms of a longer-term discount rate.
In terms of how the market is adjusting, at the moment it feels confused. What we're doing is going from one narrative to the next narrative to the next narrative, and we're being whipped around really quickly. In that kind of a world, is it possible to take a medium-term view of what is happening, given the volatility we're seeing, not at an index level, but at a sector, at a stock level?
Yeah, I think it does mean you'd have to be a little bit more nimble with your holdings. I mean, I don't think you should...
Is that easy to do?
It's never easy to do, but I think what you take a sort of view of, what do I think this business is going to be worth in, say, 5 years' time? What do I think is a sensible growth rate through the cycle? And particularly if you've got businesses that have some kind of structural drive behind them, you can perhaps have a little bit more confidence and use that volatility of markets, to add and trim as the opportunities present themselves.
So what do you like right now, Charlotte?
I mean, I think for us, we've been looking at some things like, some of the medical technology companies. We've seen a big sell-off, particularly on the sort of fears of the obesity drugs coming out of things like Novo Nordisk. I think a lot of that is a little overdone. Equally, some of the staples names have really been pulling back. I know we had the Walmart news earlier in the week in terms of, seeing slightly slower sales. But again, if you look through, those companies, these are pretty stable businesses. I don't think they're going to be completely derailed by the fact that some people are on these weight loss drugs.
So you are happy to pick stocks at this point? You're happy that what you're doing is working? What's your degree of confidence that things are going to stabilize and become easier to navigate? Do you feel that we're in kind of peak turbulence right now? Do you think it's going to get easier, or do you think the uncertainty is going to linger?
I mean, I think the uncertainty is going to linger on account of the fact we still don't know whether we're going to move into recession or not. And there's still, the pendulum has completely swung on that, from being completely consensus recession to now it's a soft landing. And so, is there still risks to that? Yeah, absolutely.
Ralph was here in the last hour. He said he's been doing this a long time. He said in his 40 years he's never seen a period of greater uncertainty. He's been more scared, 2008 pandemic, but he's never seen a period of greater uncertainty. Would you agree with that?
I mean, there's been lots of periods of uncertainty. I mean, I suppose you've added onto that the geopolitical risk that's certainly happening now, and obviously the events of the weekend are sort of, again, showing us that this is not a stable world. The relations with China, that there's a lot of things going on, and add on to that this shock that we've had in terms of being so used to zero interest rates. Now it's a different world, clearly.
Do you like bonds? Are they safe?
Well, we do own some bonds, and we probably prefer the gilt market than we would to the US, simply because we have a more negative view on the UK economy. If we're going to have anywhere really slowing down, we'd probably say it was the UK. And then in terms of corporate bonds, you are getting that little bit of yield premium on investment grade. So again, we have that. But we would say, for longer term investors, definitely equities is still the place to be.
Not cash.
I mean, cash is providing you a little bit of a, 5% yield is considerably more attractive than zero, which is where you were
Am I getting enough return on equities to justify the risk I'm taking relative to cash?
Yeah, I think if you look at, if you're buying the right equities, you're certainly getting a return well in excess of 5%, and particularly if you're owning them for longer periods of time. So, yeah, we'd still say if you're buying the right ones, yeah, definitely be there.
All right, Charlotte, thanks a lot. Thanks for coming in, Charlotte Ryland of CCLA. We appreciate it.
Pleasure.
Coming up, Standard Chartered CEO Bill Winters says that rates will be higher for longer as inflation does stay sticky. Highlights from our interview next. This is Bloomberg.